Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. A couple of quick updates just before we get into today's video. So it's daylight saving, so I'm effectively filming this an hour earlier in the morning than usual. So I hope it's not too dark. The sun's just coming out now, so hopefully the lighting and everything is okay. Second thing on that, so I've just actually ordered a new camera, which is in the mail at the moment. If you don't know, I don't think I've mentioned it before, but I do just film all these videos basically on an iPhone. So we should be getting a good upgrade in video quality hopefully in the next week or two, so stick around for that and let me know if it does actually make a difference. I hope it does. And the third thing is that with that is spring is here, got lots of upgrades coming, we're on the road to 1,000 subscribers, all that kind of stuff, so my beard just fell off. So let's get into today's video. What we're going to talk about is small cap investing versus large cap investing, and before we do that, the YouTube analytics are telling me very clearly that about 50% of the people watching this video, and I'm talking probably to you, are not subscribed to the channel. So if you do enjoy today's video, hit like, hit subscribe, and that way you can see future videos as well, and all of these sort of camera quality upgrades and those things that will be coming in the next couple of weeks. So hope you enjoyed today's video, but for now, let's get into it. So for today's video, I want to tackle a fairly hot topic. This has been debated for a hell of a long time, and I just want to give my 2 cents on it and give you hopefully a sort of value investing kind of perspective on the argument, and that is all around small cap investing versus large cap investing. So what's better? Should we invest in these little small companies, or should we invest in the big blue chip Goliaths of the world? What's better? Is one better than the other? You know, what are the pros and cons to each? So I just want to be very clear up front that when I say small cap, I'm not talking about penny stocks and the pump and dump schemes and the stocks that have no underlying actual business behind them or anything like that. I'm talking about great, fundamentally great businesses. They just happen to be small companies. Maybe they're in a small niche. Obviously Apple has a very wide market. Their market is basically the entire developed world they can sell their products to. Whereas we have smaller companies that maybe provide some sort of specialist product in manufacturing or something like that. They may be a great business, a profitable business, but they just have a much smaller sort of potential customer base. So they're never going to grow to be the size of Apple. So they fall into that small cap kind of category. So we're not talking about penny stocks. We're not talking about, random stocks that you're going to day trade and these different things. I just want to talk about smaller companies, less than say $5 billion versus the Goliaths, the large caps, north of 10 billion, 50 billion, 100 billion, $1 trillion now. We've got Microsoft and Apple, and I think Amazon have been there before, if they're not there right now, over that $1 trillion mark. So there's some mega caps, there's some huge companies out there, and there's some quite small companies that are still great businesses out there. So that's what I want to discuss. If you have got any opinions on this yourself, and there's some points that I don't cover in this video, definitely drop them down below. I'd love to hear your opinion on that. So up front, I just want to say that my preference generally is small cap investing, and that may sound a little bit strange if you've watched some of my videos before, and I'm always talking about, I want to invest in great companies, potentially well-known companies as well. Companies on my watch list of potential investments at the right price include Apple, Costco, Monster Energy, all of these really big, well-known companies. So why am I focusing on small cap investing, and why am I saying I have a preference for small cap investing? Basically, it comes down to one thing. I still have the same criteria anytime I look at any business, which is basically Phil Town's 4M's. So if you haven't heard me talk about that before, that is basically meaning, do I understand the business? Does it have some sort of meaning to me? Is it a business I'm interested in and I'm going to follow after I invest into it? Does it have a moat? So does it have some sort of competitive advantage, a moat around the castle that kind of protects it from outside competition? Does it have really good management? Are they both skillful and have integrity? And this is the kicker, and this is the real reason why I tend to stick with smaller cap companies a lot of the time. Can I buy it for a margin of safety price? So if I assess the intrinsic value of that business, can I buy it at substantially less than what I think it's worth? So that's the real kicker, and that's the reason that I tend to focus on small cap investing, and it basically comes down to this. So when you look at a business like, let's say, Apple, for example, I'll put up a screenshot here of some of the analysis of Apple that you can generally find just on apps like Yahoo Finance and that sort of thing. And what you'll see is that Apple has around 40 analysts following the company all the time. So anytime there is a quarterly update, or there's an annual report come out, or a conference call, or any sort of update on the business of Apple, there are around 40 professional analysts that are processing that information and making an evaluation on what that means for the company, putting some sort of price target on it, as they call it, and setting what they think is the value for Apple. So what you're going to see is within these 40 analysts, there's going to be some variation. They're not all going to agree on the intrinsic value for Apple. They're not going to all have the exact same opinion. Someone may think it's worth $250 a share, and someone might think it's worth $180 a share, but they're going to be somewhat close. On average, they're probably going to be around basically the current price for Apple is how that's going to work. So really, this is the fundamental reason why I don't tend to invest in the big cap companies. I would love to, but they're just so closely followed that they really never get mispriced. And as a value investor, that's essentially what I'm looking for. I'm looking to figure out the value of Apple. Okay, I think it's worth, say, $200 a share. That's not actually what I think it's worth or anything. Don't take that as gospel or anything like that. But essentially, if I think it's worth $200 a share, I want to buy it for probably $100 a share. That's the type of margin of safety that I'm looking for. And the thing is, when you've got a whole bunch of analysts, when you've got 40 analysts and, trillions of dollars invested in Apple, it's just not going to get mispriced like that. The only time it's going to get mispriced like that is if we have some sort of massive short-term event happen with Apple. If we have some sort of massive long-term event happen with Apple, in which case I'm probably not going to want to touch it anyway, or if we have some big stock market crash. And although those come along somewhat regularly, they don't come along every year or anything like that. So really my time is better spent looking at the companies that still may be great businesses. They may just have a smaller customer base, like I said, and they don't have as many analysts following them. And when you start to dive out of the top 50 or 100 or 200 biggest companies, you can start to find some really, really interesting opportunities. So I want to run you through a quick example of the type of things that you can sometimes find in these small cap and nano cap type investments. And I'm just going to run through some basic stats on this one with you, so stick around. So just to be clear, I don't think there's anything magical about small cap investing versus large cap investing. And I know there are people out there that do think there is something magical and they want to have exposure to, smaller size stocks versus larger size stocks and that sort of thing. I don't think there's anything magical at all about a small company versus a big company from an investment perspective. The only thing I do think with small cap businesses is that you can find mispricing more often, and that's the single reason why I tend to have a lot of investments in smaller cap businesses. It just happens by default. They're less closely followed, they're slightly less well understood compared to the big Goliaths like Apple and Microsoft and that sort of thing. So I just want to put that out there and make it clear that I'm not one of these small cap people that do exist out there that think small caps are great just because. I think small caps can be great and small caps can be terrible investments, just like large cap businesses can be great investments or poor investments, like we spoke about in the last video. So I just want to run you through an example of some of the mispricing that you can see in some of these small caps, these nano cap type businesses, and it's actually a business that came up on Toby Carlisle's podcast. So if you don't listen to Toby Carlisle, he's often a guest on the Investors podcast. If you don't listen to the Investors podcast, start listening to the Investors podcast. But I'll put a link down to this video podcast that I'm talking about. and he's actually interviewing a value investor from South Africa. So the South African investor invests in companies of all different sizes. He invests a very large sum of money, is my understanding overall, so he is forced into some of these larger businesses. But he's also across this company called Indequity. So I'm going to read off some of the stats for Indequity. And this isn't a stock tip or a recommendation or anything like that. But I just want to give you an example of the type of thing that you're going to be at least more likely to find in the small cap world versus Apple and, mega caps with 40 analysts following them, that sort of thing. So Indequity is a business that has a market cap of, and these figures are all in South African Rand rather than US dollars or New Zealand dollars or anything like that. So the business has a market cap, this was earlier this year when the investment was made, of around 30 million Rand. On the balance sheet, they had no debt and they had 40 million Rand in cash. So they had more than the entire market cap of the business, all the value of all the shares combined. If you were to buy the whole business, it was priced at 30 million Rand. They had 40 million Rand just sitting in cash. So first off, you've got a monstrous margin of safety there, but let me keep going. So 40 million Rand in cash, they had no debt. They also had a US equity portfolio of 1.2 million US dollars, which is about another 15 or 16 million Rand. So when you add together the US investment portfolio, which is, it's going to be very accurate, the value of it on the balance sheet, because you're getting those stocks and those bonds and those money market funds and that sort of thing priced every day and mark to market every day. So if you add those two things together, you've got a 30 million Rand business that has $55 million worth of highly liquid assets sitting there on the balance sheet. Add to that you also have a profitable underlying business. So the business earns about 13 million Rand per year. They pay about a 10% dividend. They're buying back shares. And if you do the stats on that valuation, forgetting about what's on the balance sheet, you're getting the business for a PE ratio of less than 3, of about 2.3. So ridiculously low valuation. You're getting what's on the balance sheet, and you're basically paying a negative price to get a profitable business. And that's the type of stuff that you're going to be more likely to find in the small cap world. Apple is never going to be priced like that. I think Apple has something like, I'm going to get this number wrong, I'll put it on the screen, the actual number, but let's say they have $100 billion in cash. You're never going to see Apple priced at $50 billion because of that. So instead, Apple is priced at 20 times that, and that's the beauty of finding these smaller investments. When you do find these types of situations, they can turn into 3, 4, 5, 10 baggers. You can multiply your money massively with those investments. So not a stock tip or anything like that, just an example of the ridiculous types of undervaluation that you can see with companies that are not closely followed. So I hope you enjoyed the video. If you did, hit like, hit subscribe, and I will see you in the next one. Cheers.